Have you ever bought something and later found it half price? Frustrating. With time, you can overcome the loss for most things, but what if you lost half your savings? Could you recover from that? Well, it may be happening to you right now, with you and your advisor completely unaware. How? First, understand that you can divide your life into 3 stages: an accumulation stage where you save money, a preservation stage where you enjoy living on your money, and a distribution stage where you can pass your money to family or heirs. As you move from one stage to another, your financial strategies must change as well. For example, if you follow the same investment strategies that succeeded during the accumulation stage, it could spell disaster during your preservation and distribution stage. Take dollar cost averaging. Investing a fixed amount each month into a volatile market can work during market declines, since you can purchase more shares with the same dollar amount. It's as if you spent a fixed dollar amount each month buying packs of gum to sell at a later date, but one month the packs were only half the normal price. You buy twice as much gum that month for the same dollar amount. As the market value on the gum increases over time, so does your account. But drawing a fixed amount of money out of the market during a decline depletes your savings at an accelerated rate. Using the packs of gum analogy, when prices fall, you must sell more packs of gum to capture the fixed amount of money, depleting the number of packs you have left to sell in the future. This depletes your savings at an accelerated rate. So focusing on the highest average rate of return during the accumulation stage of life may work well, but following that approach during the preservation and distribution stages could devastate your savings. Unfortunately, most people and even most traditional advisors don't understand this. Something else, medical advances over the past decades make it possible for you to survive accidents or diseases that would have overcome your parents or grandparents. Think about it. The advances of the past 2 decades increased your life by many years. How much longer can you expect to live with the advances of the next 20 years? As great as that is, the uncertainty makes it difficult to plan for the future. It's like participating in a car race that extends the distance of the race as you go. Should you stop for gas, change your tires, or go pedal to the metal? You certainly wouldn't want to run out of gas in a car race. It's the same in life. You must ensure you have enough money during the preservation and distribution stages. How? Consider the experience of twin brothers Tom and Dan. They live in the same neighborhood, had the same job, same salary, and used the same financial advisor. They saved $1 million as they entered the preservation stage of life, each expected to live for 15 more years. The only difference? Tom hired a different advisor, a specialist on investing during the preservation and distribution stages of life. Dan kept his traditional advisor and continued with the same investment approach that worked during the accumulation phase of life. He said, "If it ain't broke, don't fix it." Big mistake. Over the next 15 years, the market experienced gains in 9 of those years, ranging from 10 to 20%, and losses in 6 of those years, ranging from 10 to 20%. After taking exactly the same withdrawals to live on, at the end of the 15th year, Dan had $358,000 left. Tom, by following the advice of his preservation and distribution specialist, had $730,000. That's $372,000 more than Dan. Both Tom and Dan died that year. Dan's children had to suffer a year of probate and then lost 1/3 of the inheritance to the IRS. Tom's accounts were arranged so that his money bypassed probate, and his $730,000 created a legacy worth more than $2,993,000 to his family. That's 796% more than Dan. Think about that for a moment. They started the preservation stage of life with the same amount of money, yet Tom's legacy to his family was 796% more than Dan's. Why? Tom's advisor understood that selecting the ideal custodian for your IRA is critically important. If your money is not with the ideal custodian, the IRS may become the largest beneficiary of your retirement accounts. Now, what about you? What's going to be your story? Which path do you want to take, Dan or Tom's? If you learned today that you only had 2 weeks left to live, what would you do differently? What actions would you take to assure that your legacy was like Tom's? If preserving your hard-earned money and maximizing the distribution of it to your loved ones is important to you, the time to act is now. Don't wait another moment.
As founder and president of CD Central Financial Services, Margaret Hickson brings 20 years of experience in building lifelong relationships. Her client-centered business philosophy makes CD Central a pillar of strength in the community. Under her leadership, CD Central has grown a network of offices nationwide with corporate headquarters in Sarasota, Florida. She's a member of the $1 Million Roundtable, the American Businesswomen's Association, and the National Association of Insurance and Financial Advisors. Call Margaret Hickson at 877-925-2310 for the best of all worlds when it comes to individual financial choices.